Welcome to the Weekly Market Watch for the week of November 14th, 2025. Last week, we saw the government shutdown and AI euphoria give way to fiscal reality. U.S. equities returned 0.12%, rallying early on AI earnings and shutdown optimism, but were treated as stretched valuations and heavy tech CapEx plans triggered a late week pullback. Canadian equities returned 1.44% after tracking U.S. strength initially, but risk appetite faded midweek, leading to modest declines amid a lack of domestic catalysts. European stocks rose 1.62% on rate cut hopes and U.S. shutdown relief, but weak UK jobs and GDP data raised fiscal concerns, prompting a sharp sell-off in gilts. Emerging markets were 2.02% higher despite signs of economic strain, as slowing consumption, weak industrial output, and property sector stress were offset by fiscal support and resilient exports. Volatility reasserts itself as rate path uncertainty builds. The 2 and 10-year U.S. Treasury yields each rose 4 basis points. In Canada, the 2 and 10-year yields were up 9 and 8 basis points respectively. Global government bonds saw mixed performance, with North American yields falling on risk-off sentiment and delayed data releases, while European rates fluctuated amid shifting fiscal expectations and soft macro data. Investment-grade and high-yield bonds weakened as spreads widened despite supportive short-term rates. Primary issuance was active early in the week ahead of bond market closures in the US and Canada. The Bank of Canada's Governing Council was on the same page about the need to lower its benchmark interest rate last month, but the exact timing of the cut was up for debate. The central bank released its summary of deliberations from its decision to lower the policy rate by a quarter point to 2.25%. Those documents show council members felt the cut was warranted as a weak economy hampered by U.S. tariff was expected to keep inflation around the Bank of Canada's 2% target rate for the foreseeable future. U.S. consumers' moods dropped further in November, according to a monthly survey from the University of Michigan, continuing a slide that has worsened amid persistent price increases and the extended government shutdown, which recently ended. The Michigan survey's headline index fell to 50.3 in November from 53.6 last month, based on preliminary November responses. Analysts were expecting a milder decline in the index to 53.0. The Eurozone's industry returned to slow growth in September, reflecting moderate resilience at a time of trade uncertainty, and despite a significant drag in the month from Irish data. According to the European Union statistics agency Eurostat, industrial production grew 0.2% on month, following a 1.1% decline in August. Economists expected a 0.9% increase. Much of the drag in the Eurozone production came from a 9.4% decline in Ireland. However, output from Eurozone's 4 largest nations, Germany, France, Italy, and Spain, all grew. Production in durable goods, which are more exposed to export tariffs, decreased in September, but increased for energy and capital goods, Eurostat said. Thank you for watching, and if you have any questions, please leave a comment below. The link to the full article can be found in the description.